Hello, we're excited to have you for our online January Food for Thought event. This will be a 2020 in review and looking ahead to 2021. Lake Point Advisory Group is a retirement planning and wealth management financial services firm. We host these monthly events on a variety of topics, and we hope that they're beneficial to our clients and prospective clients. My name is Joshua Wilson. I'm the CEO of Lake Point Advisory Group and a member of the investment committee. Today, I'm joined by another member of our investment committee, our Chief Investment Officer, Rob Emrich III. A little about me. I grew up in rural Alabama. I'm a chartered market technician, credential holder, and accredited investment fiduciary, credential holder, and I specialize in the use of technical analysis and advanced risk management techniques. I earned my bachelor's from Brown University, my master's from Salve Regina University, and I am a PhD candidate at Oklahoma State University with a research interest in behavioral finance and economics. So, in getting started, first, we're going to look back at 2020, where have we been, what did we do, how do we react, and how did those things work out? Next, we'll look ahead to 2021. What about markets, inflation expectations, volatility, risk? What changes can we expect with the Biden administration? And you'll be delighted to know that this conversation today is really driven by the questions that we're getting from you to our advisors. Now, today's discussion is going to be a very big picture approach. So I want you to keep that in mind as you're listening. Talk to your advisor. The things that we're talking about are big picture, but your advisor is a specialist in knowing your individual situation and how these things can apply to you. We don't just do one general thing for everyone. We apply these things to your individual situation for your financial plan. So, this is probably a good time to take a brief moment and review what prudent investment or prudent investing really does. Prudent investing really starts with what kind of ride can you tolerate? Not just what's happening in the market and what's happening in the world, but what can you tolerate? What are you going to be able to stay with your emotional control, with your financial control, and your resources? So it's very important to understand when we're talking investments, what we control and what we don't control. This reminds me of growing up in rural Alabama. I grew up in rural North Alabama, very close to the Bankhead National Forest. And I remember when I was a child driving through this forest, and this is about the time where I started understanding what speed limits are. And I remember going through there at night, coming back from a basketball game or something with my father and mother, and I said to my dad, the speed limit over here, it says it's 60. Why are you only going 45? And Dad said, well, that may be the limit. And we had just saw a guy pass us, but they're not accounting for what they can't control. My dad understood that he could control the speed of the car, but we're going through the wilderness. We've changed from being in a small town to the middle of nowhere. So there are all types of critters that can run out in front of us, deer and even bears, panthers. There's everything you can that the rural Alabama has to offer could run out, and it could totally change what was in front of us. So what we had to understand is, what do you control? Well, I control the speed of the car. I can't control whether a deer runs out in front of the car. And this really illustrates how we were feeling in 2019. We began to lighten up on the risk in our portfolios because of the situation that I described to you last year. We believed that there was more risk building in the markets, and when that happens, if something was to come into the market and shock the market, hey, if we're going too fast and a deer runs out in front of us, we're going to correct, we're going to hit the deer, this is going to cause major problems, okay? So we began to control what we could control, lightening up on the risk going into 2020. I won't review that in deep detail, but that proactivity is really where, and that frankly, trailing the market there for a couple of months in late 2019 and building up the defense, if you will, in our portfolio, that's really what led us to being in a great position when something that none of us prepared or were expecting, that being the COVID virus, when that hit us in Q1, that preparation that we did was very solid for our portfolios and solid for our clients. But what now? And that's where I want to bring you into the conversation, Rob. Rob, the setup was great. We looked good going into it. Obviously, none of us saw it, but we did know that anything really hitting it could really cause the market to tank. So take us back to Q1 of 2020. COVID has hit. The market has just fallen, but our portfolios held up very nicely because we were prepared. But what were we seeing back then? And how did we navigate that? But start big picture.
Yeah, I mean, first of all, thanks for having me on the call. It's nice to be able to talk to everybody. I am glad 2020 is behind us, first and foremost. So let's get that out in the open. It is a new year, but it is important to go back and look at what we did to understand where we are now. And if you think about March, I remember when we were doing the portfolio allocations, they were talking about hospital ships, being in New York City and tents. I mean, that's the environment we were in. We didn't know how this was going to turn out. With the benefit of hindsight, we can go back, obviously, things look obvious, but then we didn't know. I mean, we were in the abyss. That being said, the Fed was very accommodative, as well as the federal government. So the first thing that we did was, in 2019, the portfolios were positioned with more of a value tilt or value bias, we should say. The first thing we did was we removed that bias. We said, we don't want to have a bias. We want to be able to participate in growth and value and so-called core. So we did that by increasing our exposure to the S&P 500, and that ended up being a very good move for us. The second thing that we did was we increased our gold allocation. One of the great things that happened at Lake Point was we went into gold in 2019, and that was early, but very good early, because it preceded the run up in gold. Ended up being another good decision for us, where we experienced some appreciation in the portfolios by increasing our exposure to gold. And then another thing we did was we took a more passive approach. I mentioned the S&P 500. We took a more passive approach on our equity side, and then we took a more active approach on our fixed income side. And that seemed to really benefit us, and I could talk about that further if you wish.
Yeah, and for those of you who may not be familiar with the jargon, when he says equity, he really means stocks, and fixed income is another word for bonds. And there's other things in the portfolio, but those are two very common things. You did mention active and passive, Rob. What do you mean by active and passive for those who aren't familiar? And why is it a benefit to have such a blended approach?
So active, think about, and I think this is a good analogy. Think about active is a manager or a team of managers, making decisions, trying to guess through analysis, through various models that they use to try to predict which stocks are going to perform better than the index. And we have tons and tons of research that tells us that managers, at least when we're talking about U.S. domestic large cap stocks, managers have a horrible track record with beating an unmanaged benchmark, meaning an index that just holds a basket of securities. In the example of the S&P 500, holds about 500 of the largest capitalized companies in the United States. It's better, historically speaking, to just own the index, because managers, to the tune of about 85% of them, depending on the time frame, underperform that benchmark. So what we said was, well, wait a minute, if it's statistically improbable that a manager will outperform the benchmark, why shouldn't we just own the benchmark? Why take that risk, especially when the odds are stacked against them? Now that's on the equity side. On the fixed income side, it's the complete opposite. There, the fixed income managers do make a difference. They do make better decisions. There's a lot more that impacts a bond than a stock, so to speak, meaning you have credit, you have interest rate risk. And the managers of these fixed income funds can manage this in real time. And we had managers, the managers that we hired did very well. So that ended up working out for us. We're very pleased with the results.
Yeah, and I would add to that we try to make this simple by talking active on the equity side and passive on the bond side. It's not quite that divided in real life. We're trying to keep that simple to understand. But there's also market forces moving last year that encourage those adjustments as well. And there's different scenarios where active can make a little more sense with equities, and even passive can make a little more sense with bonds, depending on where we're at, especially with the interest rates being so low. Going into a passive bond fund, owning everything, bonds that literally have no way of, they've been, the thing we have to understand about bonds is as the price goes up, the yield goes down. So some of these bonds because people ran to bonds, owning those indexes was especially scary at that time. So those were a couple of the big adjustments there, Rob. What about some of those smaller adjustments? And you don't have to jump too deep into these because obviously we want to weight the conversation towards what's going forward. But give us a little bit of background on some of the smaller adjustments during 2020, especially right after COVID, and a quick how did that work out?
Sure. So as I mentioned in March, the government, federal government, and U.S. government and the Fed were very accommodative. Now, that's a rosy scenario. We don't have the luxury in my position to sit back and just hope everything's going to be okay. We have to say, okay, what if our thesis doesn't play out? We have to have a diversified portfolio that's like an all-season tire, can handle any type of condition. So some of the smaller adjustments we made were allowing or hiring managers that are allowed to benefit from stocks and indexes dropping, called a long-short fund. And the fund that we selected was the AllianceBernstein Long-Short Fund. So there'll be long portfolio names, but then they have a little bit short of the entire index, meaning if the index were to drop, it would act as a ballast to the portfolio and really help dampen volatility. Now, as it turns out, that wasn't needed, but that's why that position was in there. It was a defensive measure. The other thing we did is we had exposure in 2019 to pure small caps. Well, small caps got hammered. Now, we didn't think small caps were going to go away, but we use this as an opportunity across the board to sell out of our small caps and then reinvest into a small and mid cap companies. And what that allowed us to do in the taxable accounts, it was nice because in the taxable accounts, you were able to take that tax loss of the small caps, yet reinvest. That's what we did. We reinvested into the SMID category, and it benefited all portfolios because now we were more diversified. And coming out of a March, we expected small caps and mid caps to both do well, and in fact they did. One of the third things we did was, it was a little controversial at the time, but it ended up working out for us, is we added a global real estate index. And it wasn't just retail. There was industrial in there. There's residential housing in there, which has done well. And depending on how long you've been a client of Lake Point, if you were a client of ours all of last year, when we did those reinvestments in April and May, March, April, May, we ended up investing in the bottom of the real estate market. One of the securities we bought is called RWO. That's the ticker symbol. I mean, it was trading at like $20 a share when we invested in it. And it's now, in the high 30s, low 40s. So that ended up working out with us pretty well too. So we're very happy with the changes that we made. Yeah.
This big picture and rewind, we've seen a lot of changes in the macroeconomic environment. We were going into COVID, we were in a low growth environment with the potential for inflation. Into COVID, we really moved into a deflationary period. And then more to stagflation, then more of a reflation. So I know that's a lot of economic words, but that's part of that big reason why we, not only added in 2019 to our gold position, but we even added more in 2020 because of that economic environment of that stagflation. Going into reinflation, those things where we're at now, those things are gonna be changing a bit.
If you don't mind me interjecting, before we talk about 2021, and I know I consider you an expert on this, and it's a tough question, but we have a new president. We have the Biden administration, Joshua, and big picture, what do you think this means for 2021? I'm going to throw that question to you.
Yeah, so we'll start big picture on this, Rob, and let's start with something positive. There's two sides to every coin. And I think the good thing to hear about the Biden presidency is global confidence. So, while Biden winning encourages a lot of people, it discourages half the country, it encourages half the country. But globally, it actually is overwhelmingly adds confidence. Europeans favor Biden 3 to 4 times higher than Trump. So that's actually a good thing for us, because whether something is true or not, won't get into any of that stuff, but confidence matters when it comes to growth. So although domestically it's going to feel like gridlock, internationally it's going to feel good to most people internationally who will have more confidence in America's ability to lead. The other good thing I would say about it, and well, as we get deeper in the conversation, we'll talk about the other side of the coin, but let's start positive now. The other side is if you're an investor, well, there's going to be a lot of stimulus going into the economy. There's a lot of money pumped into the system.
Speaking of monetary policy, one of the questions that comes up a lot from clients, and they're asking this, and I'm going to let you answer this one. We have a new Treasury Secretary, Janet Yellen. What does that mean? What do you think about that?
Well, that's a pretty boring piece of news, Rob, but I actually think it's a pretty big deal. When I want to know what to expect from someone like Biden, one of the things I like to look at is who they're getting advice from. Stephanie Kelton is an advisor. She's an academic professor that's on Biden's economic policy task force. She's actually a former advisor to Bernie Sanders, and she's literally the author of a well-known book about what's called modern monetary theory. Now, normally I wouldn't be talking about theory on something like this, but this is pretty interesting. The whole point of modern monetary theory is that governments can spend freely without worrying about deficits. In other words, if you are a government that prints your own currency, then you never have to worry about running out of money. And that's can be a little scary. Now, on one hand, I think their attitude is that you don't really have to raise taxes to spend because money doesn't matter, it's made up. But I think that could actually help them get some bipartisan support from the GOP, who will fight tax increases. Really what I think this will come down to is how much of this money is spent on investment, because he is talking about infrastructure and things like that, versus just things that feel good, sound good, and entitlement spending. The investment spending, the infrastructure will at least get a return on that, but the other side of the coin obviously could be very difficult. The bottom line is that modern monetary theory marries fiscal policy to monetary policy. And if that's your goal, which seems to be with Biden, is have the Fed and the Treasury really kind of working in unison, then one great way to go about that is to take the former Fed chair, Janet Yellen, and now put her in charge of the Treasury. So I really think that this is a sign that spending like we've never seen before is coming. So, while we as individuals, we think in terms of what should my budget be, we think in terms of how much money do I have to spend before creating a budget. That's not how the government's going to think. They're first going to decide what they're going to spend, and they're just going to spend it, right? So one of the things that we have to keep in mind as investment managers is, frankly, a lot of this policy I simply don't agree with. That's all there is to it. It's a lot of it's absurdity to me to spend freely forever as if there's never going to be any consequences. But here's the thing. We have to navigate the world as it is, not the world as we believe it should be. So a lot of this means hyperspending. It means inflated asset prices, because here's the thing, this money's got to flow somewhere. So if people take the attitude as, well, I want to take risks, I just want to get out of the stock market, things like that, that's the problem. This money's got to go somewhere. So it's going to go into assets. As long as the Fed is spending, the Treasury's on board, money's being thrown at everything, asset prices are going to inflate. So in a lot of ways, while hearing this news is scary for the long-term health of the country, the fact is this money is going somewhere, and it's going to go into assets. So, and especially assets that are denominated in U.S. dollars, because the dollar is going to suffer from all of this. So, you know, it's a two sides of the coin. As scary as it sounds, as much as I don't like to hear it, it's actually bodes well for asset prices. And if you're worried about inflation, that's kind of the funny thing. You got to own things that are being inflated. And what's not going to be inflated is the U.S. dollar. The U.S. dollar is going to suffer from this. Asset prices are going to go up. But, you know, speaking of the Fed, and obviously I just brought up inflation, Rob, and that's something that you talk about a lot. Talk to me about the Fed and talk to me about inflation.
You know, well, the Fed said there's no inflation, right? And there's two ways the Fed measures inflation, by the way. You know, they look at what's called CPI. You know, they look at core CPI, which excludes food and energy, because we don't use food and energy, so why include it? That's a joke. And the other thing they look at is called the PCE deflator, and that's a more dynamic rate of measuring inflation. The reason why I bring that up is the Fed's now going to try to target about 3% inflation, try to get up around 3% on the CPI number. On the PCE number, they're trying to target approximately 2%. That number right now, the PCE number is about 1.3, so they're below that target. Now, inflation last year rose about 1.4%. You know, that seems low, but food went up 4%. Now, energy dropped 7%. So it's going to be interesting to see the future and what the future holds. It's hard to believe that we won't see a little inflation, as you mentioned. We're already seeing it in commodities, food, as I just mentioned. Energy has come up. Those numbers I gave you were from last year. It's going to be interesting to see how inflation is impacted throughout the next year. And that's something that we were expecting it to rise. And actually, I don't think it would be bad if it went up a little bit, quite frankly. I don't think that would be a bad thing to have a little bit of inflation. I think it'll be healthy and it'll be normal. You know, I'd actually worry about deflation. So I'm actually glad this is a conversation about inflation because there are things that we can do to mitigate the impact and actually use that to propel the portfolios forward by investing in assets that take advantage of that.
Yeah, I agree. And, you know, I think that frankly, riskier assets I expect them to benefit from this. You know, right now we're seeing high debt companies beating low debt companies. We're seeing more volatile companies beating more safe companies. And I think we're going to continue to see this. You know, U.S. real GDP is absolutely killing it right now, and I think it's going to continue to accelerate. You know, a lot of this is just still the coming out of COVID. It's the rolling out. It's the confidence that's coming with the vaccines. And frankly, I don't really think there's a lot that some of the decisions that probably aren't good long-term for the nation that I expect this administration to make. I don't really think there's a lot they can do to stop the growth right now. So I expect that inflation will rear its head this year, and I expect that the GDP will keep growing.
You know, Joshua, the last time we were on a call together, and I could talk to you about this all day because you have a lot of knowledge about gold. But you had a lot to say about gold last time. And, you know, given this change in environment, what's your opinion of gold now?
Well, you know, I loved it in 2019. I loved it more in 2020. And I think that now we're really getting to a point where, as we're moving into a reflation environment, you know, people think, oh, inflation means buy gold. Not really. Gold is more better for stagflation, where we were at last year. So, we've held on to our gold position for several months now, probably a little longer than we would have normally because of the election. There was so much happening in the world and so much craziness that gold as a safe haven investment really made sense in the portfolio. However, now that we know what's going up front, I think that we're probably going to be trimming that gold. I know you and I have talked about this in the past. Not saying this is definitively coming. I'm not saying it's coming this week or next week or whatever, but I see us probably trimming that gold position, in this reinflation environment. I just don't see the reinflationary environment being good for gold. Again, not quite ready to pull the trigger on that, but it is there for trimming. And again, there's a difference in trimming your exposure for a different opportunity versus eliminating it. And I don't think we're at an elimination point at this point. Speaking of gold and stores of value, I mentioned the dollar earlier. Rob, I'd like to hear you talk about the dollar a little bit.
Yeah. First, I want to, you were talking about the dollar in terms of from a U.S. investor perspective, or actually a U.S. citizens perspective, going out and purchasing things. And I would like our clients to think of a dollar, two ways. There's $2, okay? Two different dollars, not $2, 1 + 1, two separate dollars. Think of the dollar that we're using, that we're spending, and then think of the international dollar, because they're two different things. I was on a program back in August, and after the dollar had dropped, if we use an index called the DXY, it's an index that we use to determine the strength of the dollar relative to other currencies. The index, after it dropped, all these experts came out and said the dollar is going to drop relative to other currencies. Now we're talking about the international dollar. The dollar is going to drop, dollar is going to drop, dollar is going to drop. Back in August, I had said that I think the biggest move, the downward move in the international dollar, is behind us. And I was probably one of the only ones saying that. And I remember that I was on Wharton Business Radio, and the host, was kind of pushing back, really, because everybody else is saying the dollar is going to go away. What we have to remember about the international dollar is that 2/3, almost about 60.5%, 61%, 2/3 of the central bank, global central bank reserves are in U.S. dollars. So what does that mean? It means that gives us, what we can call a seigniorage gain, so to speak. We have the dollar that is the safe haven for the world. So we look at the dollar relative to other currencies. Right now, we have two international positions. One of those is emerging markets, and the other one is a position of international companies that have solid balance sheets and pay a lot of dividends. The international piece is not hedged, not dollar hedged. The emerging market piece, the international piece with the high dividend paying stocks, that is dollar hedged. And the reason why we have that dollar hedged is because when you own international investments, the currency can account for between 30 and 65% of the volatility of a stock. We don't want that volatility. And there's been a ton of volatility, in the dollar. So we've been able to mitigate that. Now, going forward, we expect the dollar to appreciate maybe a little bit. If it drops below a threshold, we have a rules-based system. It's not, emotional. If it drops, it's proprietary, but if it drops and falls and stays below a certain threshold for a certain amount of time, it's measured in weeks, not months, then we're going to probably remove that dollar hedge on that side. Now, over to the US dollar, yes, the US dollar is going to weaken. How does that weaken? In the form of inflation. But don't mistake that with the international currency, because that is going to be measured relative to other currencies. Now, talking about politics again, just for a second, if you don't mind, Biden's got a pretty aggressive agenda. How successful do you think he's going to be, getting that agenda, to move forward?
Well, Rob, I think this comes down to, I think people miss the nuance of the 50-50 split in the Senate. As most of you probably have heard, the Senate is split 50-50 with, of course, the Democrats having the tiebreaker because Kamala Harris is the vice president, so she's the 51st vote. But there's really two ways for things to get passed. There's the reconciliation process, and then of course, there is the regular order. The reconciliation process requires 51 votes in the Senate. Okay, so that's that you'd think they could just throw everything through the reconciliation process now that they have 51 votes. However, the reconciliation process has restrictions on the types of bills that it can include. It can't establish new programs, so a lot of these new programs you're hearing about, they're not going to be able to go through the reconciliation process. It prohibits a net increase in a deficit for a period covered by a budget, which is about 10 years usually, and it has multiple steps. And the reconciliation process has to have budgetary implications. So I think you're going to see that while some of these budgetary things, and again, we talked about easy money, those will get through pretty easily, but a lot of the things that we hear about that are not budgetary related, they're going to have to go the regular order route, and those require 60 votes. So I think while these executive orders can be scary at times, a lot of things you can't do that way. And plus, an executive order is a lot weaker than something that actually goes through the typical process. So just moving from 51 votes to 60 is a big hurdle. So a lot of these goals that they have, they're going to end up settling for a compromise. Because here's the thing to remember, getting from 51 votes to 60 is kind of a big deal, because a lot of these centrist Democrats are actually closer to the GOP than they are to the really left-wing Democrats. So I think getting 50 votes is a much lower bar than getting 60 votes. So you'll see a lot of these things that he's trying to get done, they're going to come out a lot more muted than expected. I do think that we'll probably see a rise in the capital gains tax, probably up to 28%. I don't think it can get much higher than that. But that's for those of you who have considered, who are sitting on big positions of individual stock or something that you've not sold because of worrying about taxes. This is now definitely a time you should be talking to your advisor about, does it make sense to go ahead and pull the trigger on that, take the tax now before it goes up. Biden's talked about taking the capital gains tax up to the regular income tax level. I don't think he's going to be able to get that through, but I do think that we're probably going up there. Corporate taxes probably going up, not as high as he wants. Capital gains, will these taxes be retroactive? A lot of people ask about that. I doubt it. I think we'll start, for 2022. I think that's kind of the big picture stuff. But the bottom line is, I think a lot of the big programs that people are worried about probably won't end up happening quite as aggressively as people are concerned that it might happen. But that kind of brings us into the economy now, and just concerns about what's going to happen in the market. Rob, talk to me. Big picture economy. How does that spill over into the market volatility? Talk to me about the economy and volatility.
Yeah, I will say this is this is dynamic. As we get new information, we will make adjustments to our forecast. I will say now, things seem to be coming along with the vaccine relatively well. I was nervous when it, and I remember I'm always, my job is to be paranoid, to think about the things that go wrong. So I have to think about all the bad stuff so that we're protecting people's capital and preserving it so they can grow it over 5, 10, 50 years. So one of the concerns we had early on was that, roll out the vaccine, it won't work. People could have reactions. It hasn't really been tested. And we are beyond that, and it has done well. People have responded. It looks like the side effect profile is matching up to the clinical results that we saw in the pre-testing that the FDA did. And that's a positive sign. So what does that mean? So I'm not happy with the rollout. I think they should have done it better. I don't think healthcare systems and counties should have been in charge of distributing this. They're just not capable to do that. They don't have the capabilities. I would have liked to have seen it rolled out, at CVS and Walgreens and in a much more orderly fashion. That being said, we are going to get to a period this year in 2021, I believe, that will vaccinate most of the population, or at least most of the vulnerable population, if not all of it. And then you're just going to have this, pent up demand of, people going back out, getting able to go to restaurants, And there's a pretty strong probabilistic chance right now that this economy could just go gangbusters in 2021. Are there threats to that? Sure, there are threats to that. That's why we're not putting everything in the S&P 500. That's why we don't use leverage, because if the forecast is wrong, we have other pieces of the portfolio that will act as a ballast and will stay the course and we'll get through it. Don't think that's going to happen. In summary, in the economy, I think we're going to have a pretty good economy. I mean, I think we can put up some really good growth here with what we're seeing so far. Now, volatility is going to be here. We're seeing it right now. One of the ways that we use and my team uses, Joshua, as you know, but for the audience, we look at this thing called the VIX. It's on TV every day. It's on CNBC. They talk about it. It measures volatility out 30 days, called implied volatility. And the VIX is telling us, and the VIX measures each month out, going out about 8 months. So we go out 8 months in the next year, or this year, I'm sorry. If we go out towards the end of this year, we are seeing already elevated volatility. Well, what does that tell us? Tells us that it's going to be volatile. We're going to have a volatile 2021. That's okay. We're not afraid of that. Volatility can bring opportunity. So we're not afraid of it, but we expect it. It's going to be headline driven. It's going to be asset driven. We see things happening in the marketplace today, with GameStop. I mean, I took my 3-year-old daughter to Taekwondo, and the instructor's talking about GameStop, the Taekwondo instructor. So I'm like, wait a minute, where are we here? And let me just tell you that we do not have exposure to GameStop. We don't have short exposure, so you don't have to worry about that. And the portfolios are very well diversified. None of the exposure to the shorted stocks. But we're in a period of time where we're going to need to see some new regulation, and I don't think that's a bad thing. I don't think you can have thousands of investors go on a website and drive a stock up and try to drive funds out of business. Although to an extent, I think some of these hedge funds deserve it because they're not prudent with their investor money, but that's a whole other conversation. So in summary, expect a lot of volatility, but don't be scared of it. We're aware of it, and we're gonna do the best we can to mitigate it. And so far, I think this economy can be really, really strong in 2021, and I feel really good about it. And thank goodness 2020 is behind us. So.
Yeah, I mean, you mentioned the GameStop situation. For those of you who may not have heard about it, if that's possible, there's GameStop is popular place to go for kids that play video games, and basically an online forum decided that they wanted to pump this stock up and buy it, and then they found out that hedge funds, or a couple of hedge funds, had sold this stock short. That means they had taken a very risky bet that the stock was going to go down. I won't go into the details of that, but so they all got together and said, hey, let's punish these rich guys in the hedge fund and let's bid this thing up and cause them to lose tons of money. Well, to me, that's a symptom of some bubbliness in the economy. We have a lot of people sitting at home, especially young people that have lost their jobs and they're getting stimulus checks and they have nothing to do. So they're getting involved in the stock market as entertainment, if you will. And frankly, these hedge funds did not think about what they couldn't control. They didn't think of the thing that was not on the radar. What could happen? They thought they planned for everything going right. They didn't plan for the thing that could go wrong that wasn't on the radar. And frankly, this is the price you pay for that sort of ridiculous behavior. So, probably a little more you get what you deserve than Rob is on this point. I think they earned it. I think they earned the losses. And but it tells you that understanding what's happening in the market is just as important as the market itself. Back in 2019, retail traders were only about 10% of the activity of the market. In other words, the trading every day. Last year they were 25%. I haven't seen numbers for this year. I would bet it's even higher. So that means that prudent investment management is a big deal, because here's the thing: you can be right for a little while. That is, you get money, you make some trades, you throw at the momentum, whatever's making money, you put money in. That's what inexperienced traders do. They follow the excitement. They follow the rumor. This is where somebody else made money. I'm going to chase that. and they don't understand the risk that they're taking. That's the thing. The hedge funds should have known better. These individual investors, they're putting money in places that they don't understand. Okay, so it sounds like they're going to win this one, but it will come back to bite them. And thinking in terms of making money, the problem is they don't understand the risk they're taking. Just because you made money in something doesn't mean it was a risk you should have taken, right? And while if you're trading your $600 stimulus check, who cares, right? But if you're a retirement investor, this is money that's got to do you for the rest of your life. It pays as we're doing to avoid that stuff. We don't have exposure to these to shorting GameStop and all that stuff. So it's not anything that our clients have to worry about at all. When I say the market is rewarding risk, that is true. Risky assets are doing well, but this is not risk. This GameStop situation, this is speculation. Okay, there's a big difference in risk management and speculation. Speculation is based on, well, what if this and what if that? It's not based on numbers. It's not based on analysis. It is based on guesses. They're getting their friends involved and trying to gang up on people. It's going to end poorly, and it's going to end poorly for both sides at some point. The way I like to look at this is I tell people, don't jump on bandwagons that are driven by clowns. This stuff is ridiculous. It's crazy. It's going to continue to be in the headlines. Remember that the media they are paid to keep your attention. They're not paid to give you good ideas. They're not judged on their good ideas. They're judged on keeping your eyes glued on the screen, because the only way that they're successful is if you're watching. That's how they gauge success. Because if you're watching, then guess what? They got eyes on their screen. The more eyes on their screen, the more they get to charge for their ads. And that's what they're in the business of, making money. So they're always going to tell you about who made the most money the fastest. They're going to tell you about the scariest things out there. The big thing to understand is, we're prepared for these things. We're avoiding this craziness. We're staying prudent, even when others are going crazy out there and trying to chase the hottest, most interesting thing. This year, I do believe we'll probably make some shifts from some of the assets that were benefiting from that stagflation, and that should benefit from this inflationary environment. On one hand, that will be a little more risk in some areas, or what you might think of as risky stuff, but we're going to need that in order to counter that inflation of assets going up. On the other hand, we're going to be avoiding all of this speculative type things. We're at that point. We get a lot of questions about cryptocurrency. Cryptocurrency is not something that's going to affect our portfolios at this point. But as this gets more attention from the federal government, as it's more likely to be regulated, these are conversations that we could be having at some point. I doubt it's this year, but at some point, cryptocurrency could drift into the mainstream where we can understand the risk and it's not huge jumps in price. And that could be something that is incorporated into portfolios. But right now, we've made the specific decision to avoid cryptocurrency because there's so many factors that could literally lead this to just being cut off. So it's still a very speculative investment in our opinion. Doesn't mean you can't make money with it, but the what ifs are too big to consider it something that is that's a mainstream asset. Rob, as we try to keep these things under 45 minutes, so we're kind of getting close to the close here. Any parting thoughts you have?
I would like to say, thanks for having me on. Thanks for being our clients. We're doing the best we can. I'm very pleased with the results, and here's to a great 2021. And I look forward to the next time you guys invite me on to speak to everybody.
Awesome. Well, we've had a lot of great questions that were sent to us in advance that our advisors are passing on to us. So, we apologize if we didn't get to all the questions. We try to really focus on the ones that we get the most often. And we really enjoyed sharing our perspective and strategies with you. I want to thank you for being a part of our January Food for Thought. And as always, we at Lake Point Advisory Group love talking to your friends and to your family. The greatest compliment you can pay us is a referral. We appreciate those things. So please call us if there's anything we can do to help you to enjoy the retirement that you've dreamed of. Our website is www.lakepointadvisorygroup.com. Our phone number is 214-771-3363, or you can email us at service@lakepointadvisorygroup.com. Thank you so much for joining us today. We look forward to seeing you at our February Food for Thought online event. Have a great day.